Let me offer a warm welcome to everybody here. I'm John Huntsman, Chair of the Atlantic Council. Welcome to today's exciting discussion on Renminbi internationalization in volatile markets. We're absolutely delighted to be unveiling the Atlantic Council's Global Business and Economic Center's latest report, Renminbi Ascending: How China's Currency Impacts Global Markets, Foreign Policy, and Transatlantic Financial Regulation. We're grateful today for the support and collaboration partnership of the City of London, Thomson Reuters, and Standard Chartered, our co-sponsors in producing this groundbreaking report. Now, today's discussion is the final event in a Global Atlantic Council series, The Danger of Divergence, that focuses on the challenges of building an international currency in a highly volatile global economy. Now, we've already launched this report in Brussels, London, Singapore, and Hong Kong. With the rising relevance of the Chinese currency in worldwide financial markets, we've deliberately targeted a global audience for this increasingly important and pressing topic. We're excited that today's discussion will provide a comprehensive view of the issue with the European, Chinese, and U.S. perspectives all represented on the panel. So it's a pleasure to welcome our moderator, Mark Bolyat from the City of London Corporation, and our panelists, Dr. Wen Jianfang, Executive Vice President of the Bank of China in New York, Dr. Jinzhong Xia, Executive Director for China at the IMF, Mr. Jens Nordvig, Head of Fixed Income Research at Nomura Securities, and Dr. Chris Brummer, our Boyd and Gray Fellow on Global Finance and Growth at the Atlantic Council and the report's rapporteur. I'm delighted that the Atlantic Council Board of Director, fellow board member, Ambassador Boyd and Gray, is also with us today, at least he should be, I hope arriving shortly. A former U.S. ambassador to the European Union, Boyden's vision for the Council's work and support, in particularly that of Chris Brummer's fellowship, have been absolutely invaluable to our progress on global finance and economic growth. Now, today's conversation comes at a critical moment as the United States and Washington in particular is preparing for President Xi Jinping's upcoming state visit. At next week's summit, President Xi and President Obama will undoubtedly broach the concerns of the instabilities in the Chinese financial markets and explore avenues of collaboration based on the two countries' mutual interests and shared goals. In recent weeks, these concerns have moved from the field of philosophical discomfort to tangible threats as markets respond to the devaluation of the Chinese currency and that have sent shockwaves around the globe. This incident opens a window into the dynamics between the Chinese domestic economy and the global economy. China's rapid economic growth over the past decade has been instrumental in the country's rise as a key global player. Yet while this has undoubtedly created opportunities for global financial markets, it has not been without its challenges. As China asserts its position as the world's second largest economy and the largest trading nation, its currency, the renminbi, increasingly determines market fluctuations. Thus, it is critical that other major economic players formulate responses and provide regulatory oversight to mitigate the risks to the global financial system. An international renminbi, a global currency, could meet these challenges by stabilizing markets, facilitating a more competitive, consumer-oriented economy within China, and acting as a foundation on which China can build stronger ties with its fellow economic superpowers. However, the process of internationalization remains a contentious topic of debate among policymakers and experts that question its suggested impact on the global economy. Today's discussion will aim to spell out some of the issues surrounding the debate and take us a critical step closer to understanding the effects that RMB internationalization could have on the global financial system. We have a first-rate panel of experts here to delve into this topic in more detail. So without further ado, I will turn the floor over to Abel Clark from Thomson Reuters for a few remarks on the report itself. So thank you again for joining us this morning, and on behalf of the Atlantic Council, the City of London, Standard Chartered, and Thomson Reuters, I hope you really enjoy this event. Thank you all very much.
Thank you, Governor Huntsman. I'd like to add my welcome and thank you all for taking the time to join us this morning. It's my pleasure to be here at the Atlantic Council and joined by our partners from Standard Chartered and from the City of London. At Thomson Reuters, we're part of the China story. In 1859, the founder of the Reuters news service, Paul Julius Reuter, started his special India and China service, providing the first reliable conduit of news from the two largest Asian nations back to the UK. 150 years on, our company is at the intersection of currencies, commerce, and regulation. We have a partnership with CFET, the China Foreign Exchange Trading System, and provide the underlying infrastructure for onshore renminbi trading in the interbank market. We're also the leading provider of electronic liquidity for offshore renminbi, CNH, a business we've seen grow up at 350% last year. This year, that strong growth continues. We hit record volumes in August, and we're on track for setting another record in September, which I assume will come as no surprise to this audience. We're also working very closely with Chinese and international institutions to ensure that the essential data is provided to the market to power innovations such as Stock Connect. That's why we're so pleased to support today's report, and we welcome the insights and discussions it brings forward. We're also proud of our very strong relationship with the Atlantic Council. We thank Governor Huntsman for his leadership and Dr. Chris Brummer, our distinguished rapporteur, for the great work in creating this report, which is the latest in the highly respected Danger of Divergence series. The report is a detailed, considered analysis of the geopolitical context of the ascent of the renminbi. It lays out key opportunities, challenges for both China and the rest of the world, as well as recommendations for continued progress, but I'll leave that for Dr. Brummer to highlight in just a few moments. It's already had a great reception as Governor Huntsman talked to in Hong Kong, Singapore, London, and Brussels early this summer. It's already provoked thoughtful discussion between financial institutions, government, corporations, and investors on the future of the renminbi and the upcoming transformational investment landscape. The report's relevance has only increased in light of the recent uncertainty around the Chinese economy, which has been driven by slowing growth, volatility in stock markets, and the surprise devaluation in August. The IMF decision later this year on inclusion in the SDF basket, I think, is another important milestone. So hopefully this report and our discussion today can act as a guide to the issues and opportunities that the global economy faces as the renminbi seeks to become a global reserve currency. So I'd like to thank our partners once again, and it gives me great pleasure to introduce our distinguished rapporteur. Chris Brummer is the C. Boyden Gray Fellow on Global Finance's Growth, as well as the Project Director at the Atlantic Council, the Atlantic Council's Transatlantic Finance Initiative. As a professor at Georgetown Law, he lectures widely in the United States and in Europe on finance and global governance, public and private international law, market microstructure, and international trade. So it gives me great pleasure to hand the podium over to Dr. Chris Brummer.
Thank you so much for being here today. You know, this report was made possible by a very unique partnership of four very, very different organizations. We have the Atlantic Council, a premier foreign policy think tank. We have Standard Chartered, a truly unique leading international investment bank, Thomson Reuters, a global data and media company, and the ever globally minded City of London Corporation. Now, the route through which we sort of joined forces to think about such a complex and yet obviously very pertinent topic was a circuitous one, but it ultimately was the response by some of our colleagues in Asia, in particular some of the regulators in Asia, who have looked at our work on EU and US financial coordination and said, well, why don't you guys talk about Asia? After all, we are the driver of global growth. We have some of the fastest expanding financial markets, and the growth story, at least for the next 100 years, could very well be taking part in different countries across the Pacific Rim. And so we took up that challenge, and as we were contemplating what kind of Asia-related project we'd want to consider, we quickly came to the question of the renminbi. And for all the reasons for which many of you are familiar today, we understand and see the Chinese currency and the renminbi as a potential to become for Asia perhaps what the euro is for the Eurozone, insofar as it could provide an anchor currency for the region. And it is for sure the path by which China's financial globalization will occur. And it creates a wealth of new opportunities and risks for firms, investors, and the regulatory community. Now, you'll note when you look at the report that we work from the bottom up systematically, which was intentional, since it is a document that is animating a conversation, quite frankly, all over the world, with various levels of expertise and interest. Though even here, because internationalization is so technical, we have come to see that although there may be expertise in any one particular area, many people don't have a substantial understanding of how the big picture works and how the system operates. So we wanted to take the opportunity in this report to spell out to an intelligent and engaged audience, but perhaps one lacking all the expertise, to describe the internationalization process and what makes it unique. And then after putting some time into describing this process and describing the infrastructure supporting the currency, to put together some durable, credible recommendations. And when you look at the Reuters initial brief of the paper, and I'd like to say this was written prior to the devaluation, we were smiling a bit as to the fact of just how durable those recommendations were even after the devaluation. Now, to put the story together and to put our analysis together, we put in a lot of work, and we tried to do our homework as much as possible. We've talked to U.S. and EU regulatory and finance officials. We've talked to Fortune 100 treasurers, asset managers in China, infrastructure providers, bankers in all three continents, diplomats, and academics to try to put together as credible a report as possible that encompasses a range of different ideas. That being said, we saw that overwhelmingly we heard several key observations that we think hold particular relevance in today's volatile markets. Number one, China's reform of its domestic financial system is not a story of only financial, but also economic reform. As we have seen in at times startling fashion, China's longer-term success will depend on restructuring its economy in ways that make it more competitive as a whole and geared towards pushing its economy towards its service industries. And financial globalization is one very important element of that reform process. We've also seen that despite the fact that this internationalization of the currency carries a range of important benefits, it also nonetheless carries a number of potential risks. Now, corporate managers frequently observed that the internationalization of the renminbi allows for earnings made in China and other trapped cash assets to be repatriated abroad. Economists quite often pointed to the fact that the internationalization of the renminbi allows for the potential rebalancing of the global economy in a more sustainable growth path. Firms and investors in the United States and Europe noted that greater internationalization would increase the means of diversifying their portfolio investments, as well as Chinese asset managers who pointed out, particularly now, that increased internationalization would also allow for more diversification for Chinese investors and for Chinese savers. Still, as the report notices, internationalization of the renminbi carries a number of important challenges from the standpoint of global governance and international cooperation. That's obviously something we care a lot about here at the Atlantic Council. And what the report basically says is, at a minimum, the rise of the renminbi in payment systems and in global finance exacerbates conflicts among or along the transmission of three very different policy dimensions. It complicates the transmission of monetary policy, it complicates the transmission of regulatory policy, and it complicates the transmission of foreign policy. Now, the monetary story is fairly well understood. Even the partial internationalization of the currency can impact the ability of the government to control interest rates and to steer savings to preferred borrowers, which include state-owned enterprises. Similarly, liberalization undermines the ability to impose exchange rate controls. On the other hand, we note that to the extent to which internationalization is ultimately successful, Chinese monetary authorities could enjoy increasing levels of and powers of monetary seigniorage as the global financial system develops along increasingly multipolar lines. And as we were discussing earlier today, the fact that we have a Fed decision that takes into account decisions and the economic situation in China is interesting, because we tend, at least here in the United States, to think that the relationship is the other way. Along the vector of regulatory policy, internationalizing the renminbi will place new pressures on the Chinese government to reform its market supervision and to bolster the credibility of renminbi-denominated Chinese investments in infrastructure. And we've seen this now in a quite frankly startling fashion as we've seen the problems affecting the Chinese stock market, its crisis response mechanisms, and obviously as economists predict still in the future a potential credit event, we can't help but be concerned about the regulation and oversight of the Chinese shadow banking industry. So we spell out in the report a number of necessary reforms along accounting, auditing, credit rating agency oversight, and bankruptcy, along other issues. However, and this is often overlooked, as Chinese domestic infrastructure grows and develops, which it will, because it will have to if it really wants to have a market ecosystem that is credible, its regulatory authorities will be increasingly well positioned to export their own domestic policy preferences in the international community. And this is going to obviously impact over time some of the international forums, such as the Basel Committee, the FSB, and even IOSCO, as the US and the EU regulatory authorities may be in the position of not only being the makers of financial regulatory policy, but also increasingly becoming the takers as well, creating new frictions in cross-border policymaking. The final vector of complicated policy would be foreign policy. We've seen that the lucrative nature of renminbi internationalization does provide the Chinese government with more tools to reward and strengthen ties with trade partners and potential allies, as well as promote the competitiveness of its own onshore financial system and its offshore financial institutions. And prior to the crisis, and even now, we see this with the nomination of clearing banks, quotas, swap lines, and even development loans. Now, US and EU authorities have departed on how to engage this particular development. Europe has actively engaged China to construct offshore financial centers, and EU member states have competed among or with one another to adopt a renminbi infrastructure, whereas the United States has been conspicuously reserved, and instead we see Toronto aspiring to become the leading renminbi banking center in the Americas. Now, this question of foreign policy has parallel implications, as stated earlier, with the question of international financial institutions, frictions over the Asia Infrastructure and Investment Bank, as well as, obviously, the big question coming up this fall as to whether or not to include the renminbi in the IMF's special drawing rights. Now, the end of the paper makes a couple of very basic suggestions. The first observation is that agenda setting, particularly now, should be pragmatic and not inspirational. We note that sometimes there is a lack of transparency about decision making. It's a problem not only in China. It's not only a Chinese problem. It's a problem that we obviously have in the United States. But to the extent to which you want to create a regulatory ecosystem to support a market ecosystem, there has to be some sense of clarity as to the relationship between important market and state participants. Second, we note that in order for China to continue its efforts to liberalize its capital account, it has to upgrade its crisis management, bankruptcy, and supervision of key gatekeepers like credit rating agencies, auditors, and accountants. I think a couple of weeks before the devaluation, I was talking on the BBC, and I had noted that, and as many others have observed, the appreciation of the currency won't continue forever, I'd stated, and increasingly investors are going to look behind the currency to see what kind of investment is actually at stake. You're going to lift the hood, and investors will need transparency. They're going to need clean financial statements. And again, the regulatory ecosystem will have to match the market ecosystem in order to provide the credibility, the robustness, and ultimately to achieve the objective and aims of the Chinese government itself. Now, this is only going to be possible by upgrading not just Chinese, but also trans-Pacific capacity building on issues like banking, market integrity, and investor protection, and making sure that key international forums have at their fingertips experts that are familiar with the Chinese financial regulatory infrastructure. And US and EU regulators will have to do the same. Finally, we note that non-discrimination policies and private market participation should be embraced by both China and the host states of renminbi capital markets in order to bolster the market liquidity and depth of the currency and to reduce financial risk and the potential for unintended frictions in foreign policy. To those ends, we noted that one of the ways in which one can begin to address key issues, including enhanced market supervision, transparency, and non-discrimination, is to leverage this issue of SDR inclusion as not only a source of foreign economic friction, but also an opportunity. That is, the report makes the argument that when looking and evaluating the currency, as to whether or not it is freely usable, which is the key metric, if one will, for inclusion of a currency in the SDR basket, that those metrics shouldn't just be macroeconomic metrics. It shouldn't just be a question of your turnover or your volume of the currency. Instead, certain regulatory metrics should also be included. And the more interesting question from this perspective is not necessarily whether or not the renminbi should be included in the SDR basket, but really the more interesting question is, from this standpoint, what should be its weighting? And we again make the argument that certain kinds of regulatory metrics about that you already see in the IMF's surveillance programs should be introduced into the SDR basket to, on the one hand, recognize the growth and the importance of the Chinese economy in the global economy, the ascendance of the renminbi in global payment systems, but also to provide very strong incentives for continued reform not only along the capital account liberalization process for market opening, but also to provide the proper incentives to make sure, again, that those increasingly internationalized markets are supported by a robust and credible and internationally accountable regulatory system. So that's the idea. They will obviously be debated. Thus far, there's been a lot of consideration, and it sparked, I think, a very useful response. But the report, as I said, was introduced right before the summer, and a lot's happened since. So I think now I'm going to turn it over to my colleague Xuan Ding, who is the Chief China Analyst from Standard Chartered. And before we go to the panel, we're just going to look at, from a more objective sense of economic metrics, what exactly has happened to the renminbi over the summer. So, thank you.
Thank you, Chris. It is quite a challenge to discuss anything about China within 10 minutes. Let me try. It feels good to be back in DC. It's sunny, lively, but also quiet. On the other side of the Pacific Ocean, in China, it's like a roller coaster ride in the past few months. Started with the stock market correction in June, followed by the devaluation of the currency, and recently a number of data disappointment. So maybe a good starting point for me is the devaluation of the currency. So that's August the 11th. The renminbi was devalued by about 3%. Our view is it is mainly motivated by the desire of China to have the currency included in the SDR instead of devaluation to gain competitive edge. And it actually becomes increasingly clear that is a motivation because in the IMF staff's preliminary report on the SDR review, there are three issues mentioned. First is the gap between the spot and the fixing. The fixing does not reflect the market forces. Second is a gap between basically the CNH and the CNY basis. That's the onshore and offshore renminbi exchange rate has discrepancies. And the third is about if renminbi is included in SDR, what kind of interest rate should be used? And actually China addressed those issues one by one. So after the devaluation, we already see the basis point, the gap between the spot and the fixing narrowed significantly. It's almost converged. That means each day the CNY fixing is more reflective of the previous day's closing. So it is more market driven. Secondly, of course, we see the gap between the CNY and the CNH gap actually widened because of the depreciation expectation, which drive the CNH, US dollar CNH even higher. But for that, at least we see some effort from the government to address that. And there are also reports about the authorities' intervention in the offshore market in order to narrow those gaps. And a third factor actually is related to the news yesterday about China's Minister of Finance will start to issue 3-month bill regularly. And that is specifically try to address that there need to be a treasury yield curve, just like any other currency in the SDR basket. So that's why we think this is mainly motivated by the SDR. And by doing that, we think the chance of SDR inclusion has been increased substantially. And in that case, if renminbi is included in the SDR, we think it will promote renminbi internationalization further. But in the short run, if we take a look, because of the devaluation, actually we expect some short-term setback for the renminbi internationalization. We at Standard Chartered compiled an index called the Renminbi Globalization Index, starting from 2010. And the index has basically covers a number of offshore renminbi centers. And also, it is based on 4 main variables. One is the CNH deposit, overseas renminbi deposit. One is the dim sum bond issuance. The third one is FX turnover. And the fourth one is cross-border payment. And the index actually increased by 21-fold in the past 5 years. There are some, I think, up and downs, but the trend is mostly upward. But in April, May, and June, we see 3 consecutive months of decline. Until July, we see a rebound. And this is actually related to, I think, to a large extent, related to the expectation of renminbi. Our view is actually the renminbi internationalization made great progress in large part because of the appreciation expectation in the past. When the expectations start to shift, we actually see some setback. And in July, the rebound is basically caused by the cross-border payment that increased substantially. So this is a chart showing the previous experience. So when the gap between CNH and CNY increase, or the CNH discount start to increase, we will see that the globalization index drop. And if we look at for August, because we only have the index for July, we haven't captured the August development. So what could happen in August? If we look at these four variables, first is the market volatility increased a lot. This is a volatility index. Usually when the volatility increase, actually we will see FX turnover to increase because there will be a lot of hedging demand. So this is actually positive for the globalization index. And another positive is from the cross-border payment. Usually when there is a depreciation expectation, or when the CNH is cheaper than CNY, foreign importers will tend to buy the cheaper renminbi to pay their import from China, to pay the exporter of China. So that usually when there is, I think, a cheaper CNH, actually the cross-border payment increase. So two of the factors of this index may actually increase in August. But the other two, back to this one, the cross-border payment increase actually will reduce the offshore renminbi deposit, the renminbi pool, because they buy the renminbi to pay the exporters in China. So the renminbi will flow back to China. That will cause a reduction of deposit in Hong Kong. So that part is a negative. And also, because the renminbi pool will shrink in Hong Kong or other offshore centers, it will actually increase the funding cost of renminbi offshore. We already see that in Hong Kong, the HIBOR, overnight 3 months, the HIBOR has been higher than the onshore SHIBOR. So that means a lot of firms actually will choose to go back to mainland China to raise funding. Actually, we see, I think another indicator is actually the high yield bond issuance in Hong Kong is declined. A lot of Chinese firms previously raised funding in Hong Kong start to go back onshore because the bond I think the bond yield in China is even lower now. Because of funding tightness, this is actually, we already have the actual number for August. That is dim sum bond issuance. The dim sum bond issuance continue to decline because of funding tightness in Hong Kong. So overall, we think the renminbi globalization index may face a short-term setback. It may decline temporarily, but the longer term, the renminbi reform, we see it as a reform that will potentially increase the flexibility of the currency, increase the chance of renminbi being included in the SDR. And in the longer term, it should be positive for the globalization of the currency. But as we mentioned before, and also as Chris mentioned, appreciation expectation cannot be counted on going forward. For renminbi to be an international currency, it will have to be more usable. It will have to continue to open up the capital account. And also the institution need to be improved. What is more important, I think the fundamental, the economy need to be strong. Because for the US dollar, no matter what cycle, which stage of the economic cycle, or whether the US dollar is strengthening or weakening, people will always hold US dollar. I think China still has a long way in that respect. So this brings me naturally to the China economy condition right now. So I mentioned that actually I went to quite a few trips in Europe, in UK, in US and Singapore, meeting clients. So I sense a very different sentiment before and after June. Before June, people are aware of all the problems in China, overcapacity, high debt ratio, the property market correction, and the long-term task of reform. But at least people seems to think that the government has the ability to manage the short-term risks there shall be no major worry, at least in the 1 or 2 years time horizon. But that all changed after June. First is the stock market correction, and the second is the devaluation and also some weak economic data. In a sense, from my conversation with the investors, seems that the confidence in the government ability to manage the economy has been weakened. And also, people start to worry about the effectiveness of the macro policies. And that is why recently we see the Chinese leaders, a lot of statements basically trying to boost confidence and reiterate the 7% growth target. So my sense is in the short run, the government will actually prioritize growth and to adopt a number of policies to achieve that. For example, the fiscal policy is getting more active, more proactive. In the first 8 months, for example, the fiscal revenue grew by about 7%, but the spending grows more than 14%, twice as much in terms of growth rate. That is a very clear indication of more expansionary fiscal policy. And also, given the local government spending has been constrained, we see another channel, I call it quasi-fiscal policy, through the policy banks. The policy banks have been recapitalized recently, which increased their lending capacity substantially. And that new capacity will be used to support the One Belt, One Road, the infrastructure, and other key government projects. Monetary policy will continue to play a role, that the heavy lifting. We already see in August, the money growth continue to be above 13% in terms of growth, and the Renminbi credit growth more than 15%. Of course, there is some distortion in that number because some of the loans are extended to the China Security Finance Corporation to support the stock market. But overall monetary stance has been loosened quite significantly. And also we expect more to come. There could be another 25 basis point of benchmark rate cut, especially when the US postpone its rate hike cycle. And another 100 basis point of reserve requirement ratio cut will likely to be needed just to deal with the very large capital outflow in recent months. Our estimate is the capital outflow from China in the past 16 months exceeded $600 billion US dollars. Of course, here I want to emphasize capital outflow is different from capital flight. Capital outflow in this sense, in BOP sense, a lot of capital still stay within China. And some of the capital outflow is reflected in the shift of deposit from renminbi to US dollars onshore. But the capital outflow is a drain on domestic liquidity. So they may need to cut the reserve requirement ratio more. And the property market, we see some sign of improvement in terms of sales, but investment will still have to pick up. Just to wrap up very quickly, with those policies, usually the fiscal policy has 3 to 5 months of lag in affecting the real economy, and the monetary policy have 6 to 9 months of lag. With those policies, we expect some rebound of the real activity in the fourth quarter. Here, I think the chart, I tried to make a distinction between the growth rate of the real activity and the growth rate contributed by the above normal stock transactions. For example, in the first quarter this year, 7% growth, I think 0.5 is contributed by the above normal stock transaction. In the second quarter, 0.8 percentage point contributed by the stock market. Going forward with the normalization of the stock market, the contribution from that part will decline, but the blue bar, the real activity may pick up going forward. So in the second half, the headline growth could be actually lower than 7%, but the real activity will pick up. So let me stop here. Thank you very much, and I will hand over to Mark to moderate the panel. Thank you.
Thank you very much. We speak very briefly from here and then introduce the panel. It's my great pleasure to moderate the session. I'm the chairman of the City of London Policy and Resources Committee. I do not want to explain what all of that means. It could take hours, if not days and years. We've been around for 800 years. To do a project like this with 4 organizations as diverse as the Atlantic Council, Standard Chartered, Thomson Reuters and the City of London Corporation is itself an amazing feat, and it's been a very good project. City of London is very interested and very involved in work with the Chinese authorities. We follow very closely the Chinese economy. We've done a lot of work over the last few years to help develop London as the Western offshore Renminbi trading center. That work has gone very well. We have offices in Beijing and Shanghai, and we have a very regular program of engagement with the Chinese authorities. So this project is something we were very keen to be involved in. I think the timing was immaculate. Not only what happened before the report was published, but what happened after the report was published. And it's very timely that we've got this session today. So can I now invite our 4 panelists to join me on the stage? We have Dr. Wenjing Fang, the Executive Vice President, Bank of China, New York, but more importantly, he used to be in London.
Thank you, Mark.
So he's brought very valuable expertise and experience with him over here. Dr. Jing Zhongxi, Executive Director for China of the International Monetary Fund, Jens Nordvig, Head of Fixed Income Research, Nomura Securities, and the ubiquitous Chris Brummer. I'm going to ask them a series of questions that require simple and quick answers. And we will have a discussion. We'll have longer on some things than on others, and then we'll throw it open. So the first very simple question, on a scale of 1 to 5, how healthy is the Chinese economy? Well, come on.
Okay. I'll try to be quick. I think either yes or no would be a too simplified answer to this question. And I think as the health situation of any individual, it's sometimes difficult for you to say whether you're healthy or not. I think for Chinese economy, I think from Chinese bank perspective, we still think that the Chinese economy has we are quite optimistic about the future growth of Chinese economy. Two sides. As one side is we think there are still a lot of potential for Chinese economy to continue to grow in a healthy and sustainable way. And there are many opportunities there. Important things that there's still great, potential in it. For example, in the consumption, driven, economy, and also the growth of the service sector, and also the continuous reforms in finance and other areas. All these kind of things which I mentioned will provide fundamental, opportunities for the economy to grow. But on the other hand, there's great challenges ahead. I think the challenges are tremendous as well. I think how to continue the reform, the reform in the financial sector is especially challenging, and also how to reform in social area as well. A lot of things, and also how to bring reform in the law and how to realize the governance of law in China. A lot of challenges, I think, but in general, from our perspective, we can feel the vitality of Chinese economy. We still think that Chinese government is in good control.
So pretty healthy.
I think in general, I think it is.
Right.
So I think if you look at the presentation, listen to the presentation, and look at the chart, and listen to the people, they are talking about the bubbles in the Chinese economy. Okay, the first bubble is the equity bubble, and this bubble has bursted. It is bad news. But the good news is China is lucky to make the bubble burst before it is too late. Unlike the Nikkei index in the 1980s and the Nasdaq in the late 1990s, and that had quadrupled before the collapse. Now, the remaining leverage in China's equity market has been greatly reduced, and the systemic risk has been contained. Another bubble in China is real estate, but this does not look like completely bursting, but rather being squeezed and absorbed. Thanks to the ongoing urbanization process and the robust wage increase, the sales in housing market are growing, and the price is rising, especially in the first and second tier cities. Meanwhile, investment in real estate is declining. So in my eyes, this is good. Therefore, the inventory has been reduced effectively, and there will be possibly a soft landing in this sector. If our intention has been entirely been focused on the bubbles, either real or potential, we will probably make false judgment on the Chinese economy. What China has experienced in the past is by far not just making bubbles. In less than 2 decades, China has built the world's largest expressway network and high-speed railway network, the world's largest automobile industry, shipbuilding industry, and electricity production capacity. So when the tidal wave of global excess liquidity has come, countries may have built up bubbles only. And when the tidal wave has gone, so nothing could have left for some countries. But China is not this case. China has made real and permanent progress that will not be gone with the wind, but rather pay off gradually. So this is my comment on this issue.
Jens.
I'll make a very short comment on this. So I think if you think about China from a very long-term perspective, I think most indicators suggest that China is an incredibly competitive economy. You can just look at how they gain market share in global markets over the last 20 years. It's just a world record in many ways. But that's a long-term issue that is a positive. In the short term, I think there's a tremendous challenge involved with essentially what you're talking about, all the good stuff, all the investment, makes it very, very hard to sustain an investment growth along that path, and therefore we're going to have a big slowdown in that space, and that's going to lead to a very, very big cyclical challenge here the next few years.
Chris, you were nodding wisely. Well, you were nodding.
3. I actually heard your questions between 1 and 5, 3. I'm not an economist by training. I'm a lawyer. And so really all I can do is sort of repeat really some of the observations I've heard both during the writing of the report, during the presentation of the report, and then obviously what I've heard from folks really all around the world since the devaluation of the currency. And that is a sense that over the long term, China is still, the growth story of China is still very much a positive one. But there is, still a sense that there are unrealized credit events that are likely awaiting. There's a question as to what kind of governmental and institutional response mechanisms are going to be available, particularly from a legal or regulatory standpoint, where you have relatively rudimentary bankruptcy regimes, where you don't have the crisis response mechanisms in financial markets and the kinds of depth of financial markets that you see in the United States. And so there's a sense that the tools, ironically, for dealing with those kinds of crises, though from a monetary perspective we tend to think of them as larger because of the relative limitations on the convertibility of the currency, when you think about it from a kind of a regulatory standpoint, those tools are given the nature of the Chinese economy, still relatively limited. And as a result, there is a sense that there could be a hard slog for the next couple of years as you try to process inventory, as you try to process real estate, as you try to process the conversion of state-owned enterprises into more globally competitive enterprises that aren't necessarily purely reliant on M&A transactions for entry into foreign markets and the like. And that is a process that China is going to have to navigate.
Okay, I mean, we're all clear on the health of the Chinese economy. Let's move to the exchange rate. I haven't heard the word devaluation sort of mentioned at all until recently, because most currencies are floating and they devalue without there being an announcement and a lot of attention. But now it's established fact that China has devalued its currency because it announced it. That's just an observation from me. So very quickly, what's going to happen to the currency? Because I wish to put some money on the currency shortly afterwards? Up, down? Are we going to see more, quote, devaluations?
I think a more accurate word to use is a depreciation, not a devaluation, because the authority just allowed the exchange rate to change based on the market forces. I think the market response to the renminbi's exchange rate is sometimes irrational, given the different business cycles in China and the US, and the substantial depreciation of the euro and the yen in the past 2 years. So the authorities have determined to move towards a more market-oriented, flexible exchange rate regime, while trying to strike a balance between flexibility and stability. The most recent development in China's foreign exchange market has been evidence that the authorities not only intervene to prevent over-appreciation, but also intervene to prevent over-depreciation. So this shows that the authorities are responsible and honor their promise to take responsibility for maintaining financial stability. So if short-term speculative factors can be screened out, the current exchange rate may not be far from equilibrium. The newly revised rule for exchange rate formation and formation mechanism implies that the so-called reasonable and equilibrium level of exchange rate is determined by market fundamentals rather than by arbitrary subjective judgment. So there are signs that the market participants are gradually getting used to a more flexible renminbi exchange rate. So this is my comments.
Ken?
Yeah.
Yeah, so my day job is essentially to monitor global currencies, and obviously in the last few months, almost all the questions I'm getting from investors is about the Chinese currency issue. And one thing I find truly amazing is how quickly sentiment can change. So we've been through a multi-decade process of building immense currency reserves in China, world's largest by far. And now in the last few months, we've had meaningful reserve losses, and suddenly the questions I'm getting is China going to run out of reserves entirely? And I think that question is relatively easy to think about, because we still have like 3.5 trillion reserves roughly. If you look at all the external liabilities that China has in dollars, it's around 1.1 trillion according to my calculations. So those liabilities are covered 3 times over. Almost no country in the world can show that degree of strength in terms of how much reserves they have relative to liabilities. So I have great confidence that China can control its currency and create that stability that they want for a period of time. The challenge is that if the economy really is going through that cyclical downturn, to adjust the sort of investment cycle, it will be natural for monetary policy to be quite loose through that period, interest rates to be lowered and so forth. And that could create some cyclical pressure on the currency that it probably would be not smart to fight too much. So therefore, I think China can control it, have immense resources to do so. But if the economy really is going through a cyclical slowdown in the next few years, it probably would be wise to allow some depreciation.
Can I just follow up and ask a follow-up question? So you're talking about a cyclical downturn, but I think a lot of folks are understanding also the fact that the process of institutional reform is also a structural phenomenon as much as it is a cyclical one. And I'm really interested to get the market's view as to how do you try to understand the medium and long-term implications of, again, or I should say the short and the medium-term implications of not just changes in the cyclical global economy or even in the regional or Chinese economy itself, but in really the kinds of deep structural reforms that the country is trying to undertake.
Okay. Well, so I'll give one example that relates to currency specifically, and that has obviously to do with the opening of the capital account. So at the moment, there's a lot of focus on the potential outflows from China because we have some uncertainties, and typically the reaction of investors is to sort of repatriate money, or maybe even domestic investors might want to exit to some degree. But there's one element of the capital account that goes potentially dramatically in another direction. And that is if, as a step to create a reserve currency, China would allow foreign central banks to really access their domestic bond market, that could be a huge inflow. Think about it. We have like a pool of global central bank reserves in excess of $10 trillion worth. How much is a realistic percentage to have in Chinese currency? Is it 5%? Is it 10%? Is it 15%? If you multiply that percentage with the total stock, you get to very, very large figures. That could be a structural flow that could be incredibly important.
Okay. Can I add 3 points, a quick one? And so first, I think when we talk about the appreciation or depreciation, let's not forget that since 2005, in the past 10 years' time, Chinese currency has appreciated for about 35%. So that's the background. So we all know that this cannot continue forever. So the room for appreciation has become smaller and smaller, and RMB is approaching its reasonable or market rate level. So that's the first point I want to mention. The second is, I think, a dramatic and continuous depreciation of RMB is not in the interest of China. We all know what China wants to achieve. So I don't think they have done this in an intentional way, or they want to really promote the depreciation. I think the depreciation, as described by the market and by the media in the West, has been a bit oversensitive. That's my view. And thirdly, I think stability of RMB's interest, the rate of RMB, is in the interest of China, and China will continue to make great efforts to maintain the stability of RMB in order to realize its aim of promoting the international use of RMB. And also it's China's aim that China will continue to improve itself in improving its management of the rate and improving its regulation of the issue. Because as RMB become more and more widely used in the world, China is still, let's remember, China is in the process of learning the experiences how to manage a globalized currency. So that's something we need to bear in mind.
Okay, I mean, Chris talked about the SDR. Should the currency be included in the SDR basket? You gave a pretty clear answer. Other views?
I think it should, yeah, because
yes?
Just for the purpose of representing the economic power of China, of developing countries, I think it should be there.
Jens?
Well, I think we're at a pretty critical juncture here. So in order to have a currency that's regarded as freely usable and so forth, we should have stability, but we should also have a degree of market-determined exchange rate. So obviously what we've been through here, you can view as a sort of one-off adjustment. We're moving to a new regime, and therefore some smoothing is very permissible. But I think we have to watch very closely the next couple of months about whether this degree of intervention sort of subsides. Was it really a temporary phenomenon, or is it something that becomes a more permanent feature? And that, I think, would be a key element in the judgment.
Yeah. Dr. Jin.
Yeah, if you ask my answer to this question, of course, yes. So among all the candidate currencies that could be considered as freely usable, the renminbi is the only one, in my view, that is ranked actually as the top 3 largest exporters in the world. More importantly, China can potentially satisfy all these operational requirements for being a reserve currency in the SDR basket. And China has basically liberalized its interest rate, and a representative interest rate can be identified. China has a large and active foreign exchange market, and both offshore fixing rate and onshore representative rate can be identified. China has already opened its interbank bond market for foreign central banks, international financial institutions, and the sovereign wealth management fund. Premier Li Keqiang recently announced that China will soon open its foreign exchange market to the above foreign institutions. And foreign investors can now also use future and interest rate swap instruments to hedge their exchange rate and interest rate risks. in Chinese market. And Chinese President Xi Jinping has personally announced last year in the G20 summit in Australia to subscribe to the IMF's Special Data Dissemination Standards, SDDS, by the end of this year. China has also expressed its willingness to consider positively to participate in the IMF's Composition of Foreign Exchange Reserves, COFR, in a phased approach, probably. So none of the IMF indicator, in my view, could illustrate the importance of a currency better than a real international financial incidence. So it is surprising for me to see that only 2 to 3% depreciation of the renminbi against the US dollar triggered so much financial market interactions. So this is rare even for some of the SDR basket currencies. So clearly, if the renminbi is not that important, the world will not bother to pay so much attention. So the fund staff, I think, and the board members will make their independent judgment, and we will respect the result of their review and appreciate a positive conclusion.
Okay. Chris, a quick comment.
Yeah, you know, I just want to reiterate that I think this is as much an institutional challenge to the IMF as it is to China. And it's an institutional challenge for a variety of reasons. It's a question of the IMF's view of its own place in the world, you know, as China's economy grows. But it's also really a kind of a gut check, I think, for how both active and effective our multilateral forums are going to be for engaging what is effectively being, you know, other kinds of economic instruments and activities by leading emerging markets like China. I want to say, though, that part of that institutional gut check and why we advocate this in the paper and sort of re-envisioning what freely usable means, you know, how this is, you know, how freely usable is a currency when you want to put your currency to work to buy a financial instrument where you're not exactly sure of, you know, how good financial statements are. If you have hedging activities, you know, where you have things like domestic ISDA master agreements, you know, from a regulatory derivatives perspective, that are not fully meeting sort of international standards, you know, how robust are going to be, you know, your instruments that are available to hedge against the kinds of volatility that naturally accompanies capital account liberalization. Now, these are questions that I think the Chinese leadership is more than capable over time of engaging. But they're also questions that, from an IMF perspective, I think requires creative thinking, a creative dialogue, and a kind of a partnership between not only China and the IMF, but also with the other stakeholders. In order to internationalize a currency, just remember, it's not just a decision by China, just like it's not just a decision by the United States to internationalize its currency. To internationalize a currency means that you have to have a certain set of stakeholders. You have to have the private market to buy in, quite literally, into your currency. You have to have a buy-in by other foreign governments, if it's even if you do open up the capital accounts so that you can access your domestic bond market. And the question is, how do you create the institutional mechanisms to support that credibility and to promote that buy-in even after your rote capital account liberalization mechanics are loosened up? And I think, again, that's a challenge that the IMF is very quickly, I think, coming to understand and is trying to engage.
Okay. Enough from the panel for a minute. Points from the floor, questions, comments, not speeches. Distinguished looking gentleman there, followed by the other distinguished gentleman. Microphone, please.
Thank you. Thank you for an excellent panel and a presentation. My name is Albert Keidel, here with the Atlantic Council as a non-resident fellow. I'm just curious, when we talk about the renminbi in the SDR, which renminbi is this? Is it the CNY or the CNH? And this is mentioned in the report, only briefly, but there's a lot of discussion of onshore, offshore. but there are actually different currencies in the market. And which is it? And what's the implication of China having these two currencies on having it have a convertible capital account?
Okay. Jens, you have a go at this one.
I think both,
Oh,
onshore
right.
and offshore, yeah, because
Both,
the renminbi has been internationalized. So the renminbi circulating outside the border is also renminbi. So both the renminbi circulating outside the border in onshore market and also in the offshore market, they are all renminbi, yeah.
Okay. Lots of nods.
I think there is only
Right.
Robert Schroeder, President of International Investor. Referring to Mr. Ding's presentation earlier, it seems that he documents and projects what could be described as a virtual explosion in money supply. I think looking at those numbers, that's comparable to any other time in history with any other country. That's what it seemed to us. And I'm troubled also by the growth of the financial sector in particular as a share of GDP. It seems we were making that same error around 2007, 2008. Are you concerned by those two events?
Everyone looking at each other.
money.
Or
Well,
Even if you want to.
Wenjin.
yeah, I think so. I'm not sure about the second one. But are you concerned about the growth of financial sector in China? Is that the question? Yeah. I think let me take this one first, because this is my area. Coming from this sector, it's more comfortable for me. I think the growth of financial sector in China still has tremendous, opportunity as potential. I don't think it's enough now. The problem is it hasn't grown enough, and the Chinese financial sector is still not that mature in terms of compared with if you're using complete market standards to measure. Of course, great step forward have been made by Chinese financial by the parties in financial market. But why I say it's still great potential, because the Chinese financial reform, as I mentioned, is one of the most important reforms Chinese government needs to bring forward, and that reform has to go alongside the international use of RMB. A lot of areas that still needs to be reformed. I think the capital market is still not that mature, not that wide and deep. The bond market, we all know that's still underdeveloped in China, and also the financial services sector is still a lot of the new products that needs to be developed, needs to be launched. Even if you compare with the products in China now, compared with what we have in New York, Washington, still great gap there. So a lot of products still needs to be developed. So that gives a lot of potential for Chinese financial institutions to grow. So whether it's commercial bank or investment bank or consultants, things like that. Yeah. Money supply. Are you going to take that
question?
Oh, I think maybe you are when you're talking about the aggregate money supply. I think it is quite normal now. It is about a 12% increase annually. Many people is thinking that the leverage ratio in China could be very high, maybe too high. But if you compare the total the leverage ratio in China is 260, 70. It is quite normal compared to other countries which is at the same stage of development, like India or some other emerging market economies. The question is that the problem is that the corporate sector's leverage in China is higher than normal, but the leverage ratio for the government sector and the household sector is still quite low. So in general, the leverage ratio is normal. And if you consider the fact that China do not rely heavily on equity financing, so the total financing ratio in China is not very high compared with the total leverage ratio. It's less than 300%. But if you look at the total financing ratio in other countries, in developed countries, they could be as high as 500, 400, 600. So if you look at this, the whole pattern, the whole picture, and thinking about that China is mainly relying on bank loan, bank lending, not relying so much on the equity financing. And also you consider the fact that China has a very high saving rate. You will see that the high leverage ratio in China is not really that serious problem.
Okay. Yeah. Maybe just super quickly, so I think it comes back to this notion of whether you have excessive intervention in markets at the moment, right? So we've gone through a very rapid equity market rally. We've gone through a sharp downturn, as you mentioned in your remarks. And now we have a pretty forceful intervention in those markets, which in some countries would be regarded as very unusual in the equity market. And I think that tells you something about, okay, what kind, there's a difference between an equity market that's correcting to the downside without government intervention and one that's correcting to the downside in spite government intervention. I think that has to do with something that impacts sentiment. Investor sentiment are quite concerned about this feature. And that's something that I think that the Chinese authorities really need to work very hard in coming months to get on top of to push back on those concerns.
Okay. Yes, in the middle. I'm going to take 3 questions at once, and they're all going to be connected.
Thank you. I'm from the Treasury Department of International Finance Corporation. My question to the panel, and perhaps Mr. Ding, is on the bank lending. As you know, in the past 5 to 6 years, the Chinese banks have experienced a rapid increase in the bank lending, particularly 2009 and 2015. With the expectation of a slowdown in the economy, what's the impact of non-performing loans to the banking sector in the near future, and also maybe on the banking system reform? And secondly, with the increased liquidity right now, where would the bank lend? What's their strategic focus?
Okay. Another question behind. Yep.
Ted Truman from the Peterson Institute for International Economics. My question is about the report. You seem to, if I read it correctly, you seem to say, well, let's include the RMB in the SDR basket, sort of conditionally on their continuing their reform. That strikes me as putting, if that's correct, that seems a little weird, right? Because you could do it conditionally and then you can take it out later. That strikes me as not the right way to run a railroad of that type. And the related question is whether you are concerned that in the drive to put the RMB in the basket, there has been too rapid external financial liberalization and too little domestic financial liberalization and restructuring, and you will run the risk of making the mistake of many developing countries of opening up their capital markets prematurely. Thank you.
Another one?
So we're talking about making the renminbi an international currency, but of course we've seen in the media already these tremendous fears that one day the renminbi is going to displace the dollar as the preeminent currency. I mean, is that a possibility, like down the road, 20, 30 years? And what would China have to do economically to achieve that? Would it have to run trade deficits? Would it have to have a debt market like we have in the United States? What would have to happen?
Okay, we'll take one more as well. Yep.
Yeah, I want to ask a small technical question, but extremely important. A few hours ago, there was a report that PBOC told the commercial bank to increase the fee of CNY trading by 10 times. I want to ask, or even Ding Shuang, I mean, if you know that, how big deal it is. Will that kill the spot trading in China? That's important because they already killed equity futures, right? It completely collapsed. The trading volume equity futures come down by 99% in few days. And the reserve on the forwards almost killed the forward contract. Now they're trying to kill the spot market.
Okay. Right. Okay, I'm going to take one more. And I can remember some of the questions, but not all of them. We will answer them all.
Peter Battaglia, Johns Hopkins Science, another small technical question.
Okay.
As the renminbi becomes more important as an international transaction currency, will China continue to rely on the SWIFT system for executing cross-border currency transactions?
Okay, let's deal with the two technical questions. The last one, come on, quick answer. SWIFT, yes, no?
Yes, I think.
Yes?
Yes. Yeah.
That's easy.
Yes, okay.
I mean, to make that technical question interesting, right? You know, it's a question of, you know, have Chinese characters been used? You know, when you want to, up to this point in time, you haven't had as much of a SWIFT-based messaging system domestically in China, although in Hong Kong you have. And however, you see reforms to actually meet international standards with how to make things easy, how you communicate. From a U.S. foreign policy perspective, for those of you who are interested, you know, the way in which we increasingly exercise sanctions is via the banking system, and we actually do that with a large reliance on SWIFT. So perhaps, I don't know if that's the case, but lurking behind even that technical question is a very interesting foreign economic policy question as to what happens then when China goes online in the SWIFT system, and how does that impact the, you know, global economic relations and sanctioning.
Jens, you're going to answer the really technical question.
I was going to answer the dollar reserve currency status.
All right.
If okay.
Any volunteers for the really technical question?
Which, the fee?
Which I didn't.
The spot market fees.
Yeah.
I think, I personally think that, as I said, the policy of PBOC will be based on their judgment on the maturity of the market and whether things can be in control. And I think that wouldn't be, I think that's a temporary measure. That's my personal view. Because if they want to really promote international use of RMB or RMB internationalization, it's very important that the market will be able to have more and more RMB derivatives, you know, because people need more products to hedge the risks. And so in the long run, I think market will be more and more open, more and more products will be given. But I think we need to look at the current, you know, measure in connection with the measures taken by the Chinese government to maintain the stability of the RMB rate and also the equity market. That's my view.
Okay. Question about bank lending.
Can I take that? Or no?
Yes,
Maybe
your
the
bank.
question. Yeah. And first, the impact of NPL for the Chinese bank and reform. I'm from bank. I know from inside out that's what's the NPL situation of our bank, and I also know from other Chinese banks. I think Chinese banks has now, if you compare the Chinese bank now with 10 years ago, it's completely different. Chinese banks is now, if you look at the recent ranking of the Chinese banks, I think by the banks, we are now the leading, you know, we're on the at the top, you know, 4 or 5 banks are all Chinese banks. Chinese bank is in a much stronger position to absorb, you know, some amount of NPLs. According to my judgment, at the moment, Bank of China and other China, we are absolutely comfortable to absorb the NPL that we have on our balance sheet now or in the years to come. Because we are quite strong in terms of profitability, and we have a huge amount of provision put aside, and also the capital position of the banks are fairly strong. So we are not that worried about the NPL, and it's still in a controllable stage. I would say it's acceptable. And regarding the lending, you asked where the lending is going to be, and I think there's still, I'm the CIO of the bank. I keep approving deals, lending deals on a daily basis. A lot of lending demands for the Chinese banks and a lot of new areas as well. And as the Chinese economy continues to grow, there are a lot of new opportunities. I think in general, I think in addition to the state-owned banks, we still continue to lend to state-owned sector because that is a driving force of Chinese economy as well. So Chinese state-owned companies in the transforming process, and so they still have large demand to reform themselves and also to develop themselves overseas. So banks lending to Chinese state-owned companies, especially, for example, for going out enterprises, is quite strong. There's huge demand there. And the second area, I think, which is a new area, the private sector area. I myself have been amazed to see how this sector of lending has grown in my bank. You know, we have increased in lending to private sector in China. And we know that that is going to be a potential area, a new driving force of Chinese economy. So Chinese private sector is becoming more and more energized and become more and more vital. And a lot of Chinese private sectors are so, we wouldn't believe they have been quite successful in such a short period of time. Companies like Huawei is a typical example, you know. And there are other Chinese private sector companies with doing so well. So that's another area, huge area for Chinese banks to lend. In the past, it is underlent. Let's say private sector, Chinese state-owned bank, we avoid private sector, but now we know we can't avoid it, we should face it. So there's great potential there. The other potential great area is a small and medium-sized enterprise area. Again, that's a great potential there. And Chinese government, like any other foreign government, is pushing to promote lending to SMEs. In China's SME, in the past, state-owned banks like Bank of China, we tried to avoid lending to SMEs in the past. We didn't touch too much. But now we all realize that as Chinese economy continue to grow, SME will become more and more important of the economy. So as a bank, we must do business. We cannot avoid it. So all the Chinese banks, we are now lending more and more to the SME sector. Of course, we are learning as we'll try to set up our policy procedure, manage it, but there's great potential there as well.
Okay. Anybody else quickly on this one before we have the final question?
So regarding the capital market opening up, China's government has already opened up the interbank bond market for the purpose of joining SDR. But this opening up is quite cautious and limited. We only open the entry for the foreign central banks and international financial organizations and some sovereign wealth fund managers. So this is mainly the SDR holders. So, but even without considering the SDR entry, inclusion of the RMB, China's capital account has already been quite open. For example, under the FDI is very open. And the portfolio investment, we have already introduced the QFII, RQFII, and QD. And under the other investment items, it is quite free, especially for the financial institutions. So in general, China's capital account is not closed and not completely open. We are in the middle, and we are becoming increasingly open. So that's the reality.
Okay, a final question. We've got -3 minutes in which to answer it. Will the RMB replace the dollar, and if so, when?
I'll do say 60 seconds on that then. It takes quite a long time to create a reserve currency. The dollar has been around as the world's main reserve currency for about 100 years. And I remember when the euro was created, there was quite a few academics that speculated that the euro was going to replace the dollar as the main reserve currency over a period of time. That certainly has not happened. And I would say in China's case, even if Chinese economy is very large and potentially has potential to exceed the U.S. economy's size by a wide margin, what is needed to move in the direction of really having reserve currency status is more liberalization of markets, but also more transparency, I think, around the policy making in general, and then a huge amount of time.
Okay.
I think there's a long, long way to go, I think. And I think even although we are excited about the development of RMB internationalization, but if you look back, I think it started just a few years ago. So we are still at the early starting phase of the RMB internationalization. It's a long, long way to go. At least for me personally, at least another 50 years' time, I think.
Dr. Jin?
Yeah, I think at current stage, our challenge is how to catch up with Japanese yen and the British pound. Those currencies in the SDR basket, we are still very far away, even compared with euro. Not mention US dollar. Okay. I think it's now is yeah. This is our
long time to wait.
Chris, final word from you.
Yeah, but an equally important question is before you get to the international levels, just what kind of regional impact, to the extent to which the renminbi becomes a regional currency, and how does that then shape the global economic order? The euro hasn't replaced the dollar, but it's a very important regional currency in Europe. And the question is whether or not you'll have some kind of gravitational pull, which you're already seeing, but an even greater gravitational pull in the region, and how does that then impact the global monetary system?
Okay. Can I thank the panel for their excellent contributions, very good debate. Far more informative and entertaining than the TV extravaganza of 2 nights ago. Thank you. very much.
Thank you, Mark. Thank you.